Welcome to This Explainer. Look, I am incredibly excited you're here today because we're tackling a massive hurdle that pretty much every retail trader faces at some point. We're going to break down exactly how you can navigate the absolute powerhouse that is the stock market, specifically the S&P 500, even if you're working with limited capital. We've pulled directly from institutional-grade resources to map out a clear, structured, and above all, safe path forward.
It's the elephant in the room, right? Can you actually trade SPX with a small account? It's an intimidating question, and hey, if you've asked it, you are definitely not alone. Most retail traders look at the massive point swings of the S&P 500 and just immediately back away. And honestly, the fear of blowing up a small account with one wrong move is incredibly valid. You've probably heard the horror stories of people losing way more than they even deposited. But what if I told you the barrier to entry wasn't nearly as high as the industry makes it seem?
Okay, let's dive into this. $5. I want you to just keep this specific number locked in your mind as we move forward today. This seemingly small dollar amount is actually the mathematical key to unlocking the S&P 500 for the retail trader. It represents a total, fundamental shift in how we can structure our risk and actually gain access to the most traded equity index in the world.
So here is our roadmap for the explainer. First, the small account challenge. 2. Decoding index options. 3. Enter the micro E-mini. 4. The power of precision. 5. High probability trading zones. And finally, 6. Essential risk management.
Starting with Section 1, the Small Account Challenge and the Barrier to Entry. Listen, the regulatory exams for financial professionals, like the Series 7, they explicitly warn about this stuff. They note that if an inexperienced investor is approved and then sells a short naked call which carries unlimited risk, the account could lose substantial value. And guys, this isn't just a textbook warning. It is a terrifying reality. In standard options trading, a single contract often controls 100 shares of the underlying asset. If you find yourself on the wrong side of a trade using traditional sizing, a small account doesn't just take a little hit, it gets completely wiped out. That's exactly why traditional instruments are often far too dangerous for limited capital.
Moving into Section 2, decoding index options and understanding the mechanics. Now, what's really interesting about this slide is how we can visually cut straight through the jargon. You're looking at the anatomy of a standard SPY option contract right from our Fidelity source. Let's break it down together. The symbol starts with the underlying asset, in this case SPY. Then we have the expiration date, year, month, and day. Next up is a C for a call option or a P for a put option, which gives you the right to buy or sell. And finally, we have the strike price, which is the specific price the option can actually be exercised at. Getting comfortable with this string of characters is your very first step to real market literacy. But here's where we really need to distinguish between standard ETF options, like that SPY we just looked at, and true index options, like the SPX. The crucial point here lies in their structural differences. See, index options like the SPX are European style. This simply means they can only be exercised at the actual expiration date. Contrast that with standard ETF options. Those are American style and can be exercised basically at any time. Furthermore, SPX options are cash settled. You don't have to take delivery of 500 different stocks. The difference in value is just credited or debited to your account in cold hard cash at expiration. This cash settlement makes index options incredibly efficient, but historically, they were just way too expensive for small accounts to even touch.
Which brings us to Section 3, enter the micro E-mini, scaling down the market.
So, what exactly is it? Well, a micro E-mini is a futures contract that is exactly 1/10 the size of a standard E-mini contract. Remember that $5 number we started with earlier? While a standard E-mini S&P 500 contract moves at $50 per point, the micro E-mini moves at just $5 per point. It gives you the exact same exposure to the major benchmarks, but it radically reduces the margin requirements and the actual physical dollars you have on the line. It's an absolute game changer.
And this brilliantly illustrates that fractional advantage in real terms. We're looking at a cost comparison from the CME Group. If you were looking to put on a specific vertical call spread using the standard E-mini, it might cost you somewhere around $2,112.50. But if you use the exact same strategy with the micro E-mini, your cost drops to just $211.25, literally a tenth of the price. It's the exact same trade geometry, the exact same market, but engineered for a fraction of the cost. This right here is your definitive proof that small account trading isn't just some pipe dream. It is functionally built right into the market's architecture.
Section 4, the power of precision and tactical scaling.
You see, having a smaller instrument isn't just about affordability. It's heavily about strategy. Every trader has experienced the absolute frustration of buying a standard one-lot contract
taking a small profit just to secure a win, and then watching agonizingly as the market continues to rocket higher without them. We've all been there. But because the Micro E-mini is 1/10 the size, instead of buying one standard contract, you could buy a 10-lot of micro options. This allows you to scale out incrementally. As the market moves in your favor, you can sell 3 contracts, then maybe another 3, banking profits all while leaving runners in the market to capture that broader trend. This precision scaling is exactly how institutional professionals manage winning trades, and now you can do it too.
Next up, Section 5, High Probability Trading Zones, Stacking the Odds.
Okay, so having the right instrument means absolutely nothing if you don't know where to enter the market. To find these entries, we turn to a framework from Price Action Ninja, which hinges on one master concept, confluence. Confluence is the alignment of multiple technical signals at a specific price level. You aren't just looking for some random arbitrary line on a chart. No, you are waiting for multiple layers of technical evidence, like say a demand zone overlapping with a historical support level, to confirm that institutional money is very likely stepping into the market. We are literally stacking the odds in our favor before we risk a single dollar.
Let's move on and see how this builds a trade step by step. First, you identify a fresh, untested supply or demand zone on your chart. Second, you layer on additional context. You ask yourself, is this zone sitting at a major psychological round number? Does it align with a historical support or resistance level, or maybe a major trend line? Finally, step 3, you wait for a price action signal, like a strong rejection wick or an engulfing candlestick pattern, right at that exact point of confluence. You don't predict what the market will do, you let the market prove its hand at these high probability zones.
Bringing us to our final section, Section 6, Essential Risk Management, Protecting Your Capital. Even the highest probability setups will eventually fail. It's just a fact of trading, which is exactly why we need strict rules. Professional traders survive because they are first and foremost professional risk managers. According to industry studies, professionals typically risk only 1% to 2% of their total account balance on any single trade. This is the golden rule, folks. It ensures that even a string of unavoidable losses won't permanently damage your portfolio. But more importantly, it maintains your emotional stability. When the financial risk is small, you don't make panic-driven decisions. You stay calm and you stick to the plan.
Let's anchor this concept to some real math. Say a trader has a $50,000 account, and they adhere to that 1% rule. That means they are risking a maximum of $500 per trade. If the setup fails, they lose $500. Not ideal, but they still have $49,500 left to deploy tomorrow. Now let's scale that down to a much smaller account. If you only have $5,000, your 1% risk is just $50. By utilizing those micro E-mini options we discussed earlier, risking just $50 on a high-probability confluence trade is entirely 100% possible. You can trade exactly like a professional with strict capital protection regardless of your account size.
So, there you have it. We've completely broken down the barriers. You now know about the capital efficiency of Micro E-mini options, you understand the tactical edge of precision scaling, the absolute necessity of technical confluence, and those non-negotiable rules of risk management. The tools to access the massive SPX market safely are sitting right in front of you. The only question left to ask yourself is, are you ready to plan your trade and rigorously trade your plan? Dive into the charts, study these instruments, and take full control of your financial education. Thanks so much for joining me on this explainer, and I will see you next time.